We remain bullish on gold here. We think the outlook is still quite positive heading into next year. Easing by the Fed continues to be supportive for gold, and fundamentals continue to be positive as well. We expect central bank buying to continue, and physical demand, we think, will remain resilient even as prices continue to rally. And finally, investors, we think, still have a lot of room to build gold positions here. Generally, we think the market is still underinvested in gold, and therefore there's room for more allocations to be built up.
Now, as we were looking at gold prices, about 2,700 thereabouts, when do you expect us to cross a 2,800 or 2,900?
So we have a year-end target of 2,800 for this year, but given the price action over the past week, the risks are kind of building to the upside there. We do have a 3,000 target for next year. I think a lot of uncertainty between now and the U.S. presidential elections, and given persistent geopolitical risks, we could see choppy price action over the next few weeks. But we think that the skew is still to the upside for gold prices.
I've been doing some reading, and there's an article in the FT talking about gold prices decoupling from traditional historical influencers like interest rates, inflation, and the dollar. Are you seeing this, and what can be behind this?
There's definitely been periods of a breakdown with that traditional relationship between gold and real rates, and to an extent the dollar as well. And I think that's because of gold-specific drivers. Firstly, the central bank buying has been underpinning the gold market over the last couple of years as purchases have stepped up following the sanctions on the Russian central bank. And also physical demand, particularly at the beginning of the year, was very, very strong, and I think that underpinned the market as well. And then finally, positioning, I think, has been a key factor, given the fact that investors still hold little gold, or started the year holding little gold. I think that also provided resilience even as real rates were rising.
As we look at gold prices trading at record levels, would it be advisable to hold physical gold, or would you also recommend buying, if you're in the stock market, buying into gold miners?
So I think the choice of exposure really depends on an investor's risk appetite as well as mandate. So it depends on the type of investor. Some investors, especially that are concerned about credit risks, tend to hold physical gold, whereas for those who are looking for more leverage can tend to look at equities, and other precious metals, actually, such as silver, also provide opportunity for kind of more leverage to gold price action.